I think it's quite reasonable for people to be concerned. If you're all happy, happy, joy, joy, there can be no clouds on the horizon. That, is a recipe for charging off a cliff at some point. And no price can go vertical forever. So I think it was quite reasonable for people to be concerned about how much, how quickly, how fast these things were rocketing, even though on the fundamental level, of course, they can go much higher. That's not the point. The point is when something goes like that, history experience says it's prudent to be cautious about a move like that. And so if you have an environment where everybody is, watching that chart, and then there's any kind of correction, then of course there's going to be a very sharp pile-on effect with people like, and people will hit the bid. And it's not necessarily because they've given up or changed their minds or anything. It's just, they have huge gains and they shouldn't let them slip through their fingers. I think that's perfectly rational. And yeah, there's, let's just say emotional people on social media will lambast you in the comments for saying anything other than whatever your favorite thing is. It's going to the moon immediately, right now, right? But of course, things, even if they ultimately do arrive at the moon, nothing goes in a straight line in markets for long. So in many ways, what we've seen seems perfectly normal to me. And just real quick, we had a pretty sharp correction that silver, as you and I speak, is back up to 80, which is, okay, it's not a real all-time high adjusted for CPI, but it's still a very high price relative to recent years, and certainly relative to the price assumption used for building today's silver mines. In other words, it's a fantastic price. Like the silver miners and the gold miners are literally making money, right? If gold and silver are real money, they are literally making money at this point. And their margin expansion has been substantial, which we should see in earnings coming up. So, yeah, I'm not crying foul. I know some people saw manipulation in the sharp correction, and maybe there was. We'll never know. But to me, it just seems perfectly normal market activity.
Long-term macro arguments for gold remain intact. Persistent deficits, currency debasement, geopolitical instability, and central bank diversification. However, being fundamentally correct does not guarantee short-term gains. Markets frequently correct even within powerful secular bull cycles. Investors who rely solely on a macro thesis often struggle with volatility. Technical analysis, while imperfect, can help identify overheated conditions. Even if a major structural shift, such as expanded BRICS gold backing, unfolds later this decade, metals could still experience deep interim pullbacks. The lesson is simple. Conviction about the destination does not eliminate turbulence along the journey.
The problem with being a fundamentalist or having a macro thesis like money printer go burr, right? I agree with that, and everything around that, I get that. And the central bank buying and all these things. And those provide a basis for our expectations, but they don't tell us what's going to happen next. Right? You can be completely right. Like, let's say the BRICS countries are working on a gold-backed BRICS currency and they roll it out in 2027 or 2028. That doesn't mean that gold can't and silver can't correct substantially more before that happens. So being bright as a fundamentalist, it doesn't necessarily help me with the trading that much. So hat tip to my technical brothers when they get that right, brothers and sisters there. But to answer your question, let me put it, very bluntly. Let's say we are looking at a 2012 moment. That a couple of weeks ago, that was the top. We're not going to see higher prices for years to come, and we're headed for a bear market. If that's true, if you bought gold in 2011, and you top tick that market, and you top tick silver in that market, you're up more than 2x, 2.5x from those prices today. Okay, it took 15 years, but and I'm not dismissing that, but I'm saying that's not the end of the world. Like, if you're a long-term fundamental investor here, and of course, it took 15 years to get back to this double. It took a little bit less than that to get hold again. And if you were a fundamentalist investor and you saw that your thesis hadn't changed and you averaged down, and if you just, very few people bought at the very top in 2011. I'm trying to present the worst case scenario here, Vladislav. So like, if you top tick that puppy, 2011. You're pulling your hair out for the next 5 years, but you believed in why you bought and you averaged down, then you would not just be, 2x, you'd be 3x, maybe even 4x, depending on where you bought. If you bought the low, which was under 1200, you could have 4 times your investment in just the gold. Now, the gold stocks are another story. We'll get to that. But I'm trying to frame my answer to you. So if 2011 is our worst case scenario, that is not only survivable, but it creates an opportunity for anybody that missed it. Like we're talking about top ticking, and most of us, of course, didn't. And the other thing this reinforces is something that you and I have talked about. I talk about all the time, is that nobody goes broke taking profits. I said this on the way up. Rick Rule famously, rocked the boat by saying recently that he sold 80% of his physical silver. Okay, even I'm not that Darth Silver. I don't sell bullion at all. That's my savings. Unless I need to dip into savings for, an emergency or a once in a lifetime opportunity. I only buy. I don't sell. I don't trade them. I don't invest in bullion. That's my savings. But the stocks, you betcha, I took a lot of profits recently on the way up, not because I knew this was going to happen, not because I think it's 2011, just because I had them. They're profits. That's what they're for. And you can rotate them into other investments. And then people say, oh, I like gold and silver. Anything else I don't like. Well, what else would I do? Well, I just paid off my mortgage, Vladislav. I went to the bank and I gave them the check. And the person, they didn't even know what to do because nobody does that. So they had to bring out the 3-ring binder to find out what to do. They took my money, and I looked the bank manager in the eye and I said, "This is freedom." And she smiled, and everybody behind the counter, they all grinned like they understood, right? So you're not a trader to gold or silver if you take some profits on the way up, and then if something like what just happened over the last couple of weeks happened, you sleep well at night. So, I just want to make an appeal to those emotional people on social media. Call me names if you want, but I paid off my mortgage. And if you had been less religious about your position and had taken some money, then you could not only be in a position to do things like that, you would have the cash to put your convictions into effect now. Like we were talking about 2011, if that's the worst case scenario, imagine being illiquid and not being able to take care of that opportunity. That would have let a 4-bagger slip through your fingers. So for multiple reasons, I think it makes sense to just stick to, fundamental investing principles. Don't get overly emotional about your positions. Don't get married to them. Like Doug Casey likes to say, these crappy junior mining stocks, they're not family heirlooms, right? They're trading sardines, right? And nobody goes broke taking profits. And taking profits gives you the cash to move into the next big opportunity or or to buy the dip when the time comes. Sorry, okay. Bit of a rant there, but there's so much emotion and angst out there. But we've seen all of this before. We know what to do in this case if we just have the discipline to follow what we know works.
Consider the 2011 peak in gold and silver. Investors who bought at the top endured years of stagnation. Yet even in that worst-case scenario, long-term holders ultimately recovered and doubled their capital over time. Those who averaged down during weakness performed even better. The experience underscores 2 realities: patience matters, and downturns create opportunity. Today's environment differs significantly from 2011. Gold is more widely accepted as a strategic reserve asset, institutional participation is broader, and central banks are active buyers. While corrections may occur, the structural foundation appears stronger than during the previous cycle.
Yes, that's true, but don't kid yourself about the excellent space the business finds itself in. And one of my favorite things about this is actually very Warren Buffett-y. Right? There's a moat here. There's a huge, wide and deep moat around the miners. If you've got a profitable mine now, the best case scenario is your competitors have a shovel-ready project that's going to take a year, 2-3 years to build. And they have to have the permits, they have to have the financing arranged. These things are starting to happen. But mining is a space where high prices, yes, they cure high prices, but not like that. Can't spin on a dime and give you change. It takes time. And right now, these guys are printing cash and their competition is at least a year behind. What an enviable position that is. So this is great. We get it. I'm sure the audience understands this. They don't need to tell me how margin expansion is beneficial for these equities. But let's say gold isn't done correcting for now. Let's say, it drops all the way down to 4,000 and silver drops all the way down to 50. Oh, woe is me. Whatever will we do? Well, the miners will still be making money hand over fist, but the market will puke. Like if the metals move that much, it's unfair, it's unjust, maybe even illogical. But the leverage to the downside is always more than the leverage to the upside. And the stocks are leveraged to the underlying commodities. So I have no doubt in my mind that even the very best in the space, if there's another big downdraft, another $500 down gold day or something like that, or 10% drop in silver in a day, I have no question that the stocks will get hammered. And then we come back to what we were talking about before. If you're all in and you're liquid, what do you do with that? Cry on your beer. If you've taken some profits and you see something like that where the stocks get oversold, like totally out of proportion to their capacity to return value to shareholders, that's an opportunity and you've got the funds to do something about it.
One of the most overlooked principles in investing is simple. No one goes broke taking profits. Trimming positions after significant gains is not a betrayal of conviction. It is prudent risk management. Redeploying capital, reducing debt, or strengthening liquidity enhances long-term resilience. Investors who remain fully committed without flexibility often suffer during sudden downturns. By contrast, those who harvest gains gain optionality. Cash provides the ability to buy oversold assets or seize unexpected opportunities. Emotional attachment to positions can be costly. Markets reward discipline far more than unwavering loyalty to any single asset.
The answer would depend on your outlook. Like if you are convinced that this is just, a shoulder before the head, that we're about to go off into the blow off top phase of this market, then if that was me, if I believe that, like the next move is imminent and it's way up, woohoo, to the moon. If that's what I believed, I would absolutely focus on the majors, because that's where the new money coming in, not to say dumb money, but the Johnny come latelys, they're going to Google what's a gold company and who they're going to find, right? Or, what's a big silver, what's a silver company, right? Who they're going to find. That's why Doug Casey called these go-to companies. I think the go-to companies get there first. And if we get this huge surge, never mind what we just saw, but a bigger hockey stick, 10,000 gold, right? 200 silver, whatever. And then we get the other side of that peak. There may not be time for it to trickle down to the developers and the juniors, but the go-to companies will move, and they'll move, with gusto. So if that was my outlook, that's how I would play that. Personally, that's not how I see things. I think that I had been before, honestly, before 5,000, since 4,000 plus, I've been thinking that it was time for some correction and consolidation, like we saw at 2,000 and 3,000. And in my view, that's healthy, right? Shakes out the weak hands. You build a base and then you move on up based on the fundamentals. You keep going. So, okay, it was a little bit more exciting and more energetic than I thought. But if that's where we are now, I think that's great. That's healthy. Again, it shakes out the weak hands, sets a base before the next move higher. And based on my fundamental view, that fits, right? Has the money printer stopped going burr? No. Have the central banks stopped buying gold? No. Has the world, suddenly embraced peace? Has Russia stopped bombing Ukraine? Is the Middle East completely settled? No. Right? None of these factors are bearish for gold. So, what am I saying? I'm saying that I see more upside than downside. The worst case scenario here, 2011 style scenario, is still limited and becomes an opportunity in due course. And I'm not sure that we see anything like 2011. Honestly, I think I'm wandering off your question here, but the setup is different. For one thing, for example, I don't know if you were active in the market in 2011, Vladislav, but in 2011, we really hadn't seen anything like that. Like we were picking ourselves up off of the floor in 2001. And the only real reference, there were some minor bull rallies in the 80s and 90s, but really the main reference was 1980. So when we had that peak in 2011, a lot of people were thinking that's it. It's going to go down, like back down to $200 an ounce, right? Or less or something. They didn't believe that peak was sustainable. That just turned out to be a foothill compared to what we've seen now. So I think this is extremely bullish, actually. And people know that. Like before 2011, it had been generations in finance since anybody saw gold do anything interesting. Like people just didn't believe it. And now, it's very different. Gold has gone mainstream. And it's very funny. I just saw some guy on Bloomberg talking about how the debasement trade is new. It's only a year old. Like we've been talking about debasement since 1971. But that tells you how the mainstream, the Johnny-come-latelys, come to this, and they have no context, but they're aware in a way that nobody really was aware or believed or cared about in 2011. So I do think circumstances are different. My personal outlook is that we're in a consolidation phase, and I do think the next major move is likely to be higher, not lower. But that consolidation could be substantial. From 5,000 plus or minus 20%. That's $1,000. $1,000 swings is just 20%, but $1,000 swings will certainly, scare a lot of people and create a lot of opportunities in the stocks, which will add leverage to those swings.
At current price levels, gold and silver producers are generating substantial free cash flow. High commodity prices expand margins dramatically, and new supply cannot materialize overnight. Permitting, financing, and construction timelines create a natural barrier, a competitive moat for existing producers. However, mining equities remain highly leveraged to metal prices. If gold or silver falls sharply, mining stocks often decline disproportionately regardless of profitability. This volatility can feel unjust, but it creates opportunity. Investors with liquidity can capitalize on oversold conditions, particularly when fundamentals remain strong despite temporary price weakness.
Let's say that, there'll be like margin compression there on the buying. If you're a central bank and you've got marching orders to buy, I doubt they have marching orders to buy a certain number of ounces per month. I doubt they have a dollar amount either. Like they're not stupid. Or maybe, Doug Casey famously said that central bankers were morons who dress well, but that was in the days where they kept selling the stuff. Maybe it's a new generation of central bankers. But obviously, if you're accumulating, you're going to watch for volatility. You're going to buy on the dips. And in fact, if you look at the volume, it seems to me that that's exactly what we've been seeing on this stair step up from $2,000. The central banks, when gold goes on sale, they buy the dip, and that the central bank buying by itself is a game changer. But to have some collection of entities with such deep pockets willing to step in and buy the dips, that might be the very thing, we'll find out in the future, but that might be the very thing that stopped the slide this time. There was major panic a week ago, but somebody stepped in to buy the dip. And I don't think it was George Soros or even Druckenmiller or Gundlach or the more pro-gold types. I think we'll find out in the future with central banks. So that's really important. I don't think the central banks are by themselves driving the gold price higher. I think they're preventing it from backslipping when other forces drive it higher. They're buying the dips. But to your question, okay, so let's say they had a goal of we're going to buy, $50 million a month of gold. That will buy less and less gold every month, but you're still buying your $50 million, and prices are determined at the margin. So they're still buying every month. So that's my answer to your question. No, I don't think that's a worry, but I think it doesn't work like that. I think that they will tend to buy the dips, and I think their marching orders. I'm not in, I have no fly on the wall. I'm not Mossad. I can't tell you what's really happening here from my secret sources. But my impression is that the marching orders are look, we got to diversify. We want you to shift 10% gold. Like Morgan Stanley says, we want 10% gold in our reserves, and we want you to accumulate until you hit 10%. So I could see that happening, and we don't know what those goals are, but at some point, if you're the Bank of Kyrgyzstan or whatever, and you get to that allocation where you were told, by your political masters, accumulate this much gold, and you achieve that goal, well, then I can see that you might stop buying. But I don't think the price has anything to do with that. They will buy until they achieve whatever diversification goals they have. And I think in the case of particularly Russia and China, and maybe some others, but particularly in those cases, I don't know that there's any stop to how much they want to harden their assets and diversify out of the dollar. So I should just say real quick, I saw reports that Russia was selling some of their gold recently. I saw counter reports that they were selling it to themselves, and it wasn't really how it looked. But like, just think about that though. If Russia was selling gold, and the worst it could do was knock gold from 5,600 down to 5,000, like, that is huge. That tells us something really solid about this market.
A defining difference in today's market is central bank demand. Many nations are diversifying reserves, steadily increasing gold allocations. Unlike speculative traders, central banks tend to accumulate during weakness rather than chase rallies. Their presence may be limiting downside volatility by absorbing supply during corrections. Meanwhile, geopolitical tensions, currency competition, and fiscal expansion continue to support long-term demand for hard assets. While consolidation phases are likely, even substantial ones, the broader macro backdrop remains constructive. In this cycle, pullbacks may represent pauses within a structural uptrend rather than the beginning of a prolonged bear market.